Gold and silver have not been performing well at all. Not at all. They've been horrible, and they're still horrible. Because if you look at the valuation of gold and silver relative to stocks, if you just had a stock portfolio since 2011, so first of all, on a long term since the 1970s, and also if you count since 2000, yes, gold and silver have both been performing better than stocks. Yeah, that's true. But they have not been performing well, and they're nowhere near, not even close to their tops relative to stock portfolios.
These are dollars that can, within a day, come chasing the safe haven asset in a crisis, and a crisis is coming. October is always the spooky month.
For over a decade, critics have pointed to the underperformance of gold and silver relative to mainstream equities as evidence that precious metals no longer serve a meaningful role in modern portfolios. Since 2011, broad stock indices like the S&P 500, especially when factoring in dividend reinvestment, have delivered strong returns, reinforcing the belief that metals are relics of a bygone era. However, this view often ignores the longer arc of monetary history. Currency crises are not sudden events. The erosion of purchasing power began in earnest with the decoupling of money from tangible backing, notably when gold ownership was restricted in the US in 1933. That decision marked a shift toward an inflationary monetary regime, one that has continued to expand through debt accumulation, monetary easing, and political expedience. Rafi Farber, author of The Endgame Investor, argues that gold and silver should not be evaluated solely as investment vehicles. Gold, he explains, is the historical benchmark for maintaining purchasing power across generations. It is not designed to outperform equities in bull markets, but to preserve value when currency regimes falter. Silver, while more volatile, offers tactical advantages during periods of acute disruption. Farber believes that the monetary system is slowly cracking under the weight of its own contradictions, and that metals will not merely appreciate in price, they will reassert their foundational role in economic life. This evolving financial reality suggests that precious metals are not lagging, they are waiting. They are waiting for the moment when confidence in debt-based money wanes, when investors and nations alike recognize the limits of paper wealth, and when the velocity of capital moves urgently toward tangible value. Rafi Farber emphasizes that this turning point may not arrive with headlines or dramatic policy shifts, but rather through subtle signs: rising physical premiums, increasing central bank gold purchases, and the slow exodus from U.S. treasuries. When this quiet shift becomes a broad realization, gold and silver will not just catch up to equities, they will serve as lifeboats in a storm. Now, we present the clips from Rafi Farber's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
When a treasury is a vehicle to pay future dollars in dollar terms based on a dollar that's already existing because it bought a treasury. So you're talking about a self-reinforcing loop. The treasuries are units to pay future dollars, which themselves are treasuries, which themselves are dollars, which themselves are treasuries, and so on and so forth until the whole thing spirals out of control. So should interest rates be higher or lower? I know that these aren't like the answers that you wanted. You wanted me to give, a number, what interest rates should be. Well, I mean, we could play that game. Let's say if interest rates are, let's say 20%, what would that do? That would collapse the banking system. Well, if interest rates are 0%, what would that do? That would collapse the dollar. So it's one of those two. One of those two is going to happen. It's not going to be collapsing the banking system because then the bankers will get very upset. Instead, it will collapse the currency, and that will collapse the bankers, because when the bankers have no more dollars and their dollar can't buy anything, and they have banks full of dollars, they have nothing, and then they'll collapse anyway. End of this, no matter where interest rates go, higher or lower, means the banking system is going to collapse. And when the banking system collapses, that means everything is reset. All valuations of everything will be reset to money and not to credit. And the question is, who will have the money? And the answer is whoever has the gold and silver. They will be able to use their liquidity to acquire whatever capital remains, and everything will be redistributed based on who has the money and not who has the credit, because the credit will be worthless. Currency collapses do take a long time. This one has been starting since 1933, and what are we now? 2025, so we're like 92 years into it. It started in 1933 because that's when Roosevelt made it illegal for for his citizens in the U.S. to own money, and he said you can only have my credit now, and I'll take the money, and that gave them that gave the central bank carte blanche to inflate the credit supply as much as it wanted, because without people being able to redeem their credit for money, they could control the inflationary system, and now we're year 92. So yes, currency collapses can take a very long time, as this one has. The question is, how much longer can it take? I think more than a few days. Do I think more than a few months? No. I think we're at the end. I dispute and I reject what you just said. Gold and silver have not been performing well at all. Not at all. They've been horrible, and they're still horrible. Because if you look at the valuation of gold and silver relative to stocks, if you just had a stock portfolio since 2011, so first of all, on a long term, since the 1970s, and also if you count since 2000, yes, gold and silver have both been performing better than stocks. Yeah, that's true. But they have not been performing well, and they're nowhere near, not even close to their tops relative to stock portfolios. If you have a guy and he just he has a 401k or whatever he has, and all he did was just invest in the S&P 500 ETF, and that's it, nothing else. Just kept reinvesting in that, investing his profits into that. He'd have a lot more money than if you invested in gold since 2011. So no, gold has not been performing well at all. Neither has silver. If you look at silver relative to the S&P 500, it's almost nothing compared to what it was in the 1970s. Silver has not been performing well. So if you look at the dollar number, yeah, it looks like it. But if you're gonna compare it to someone who has been investing in mainstream stocks for the last 15 years, it's been doing horribly. So I expect that to change very quickly. And once we see that gold and silver holders, those who have physical gold and silver tucked away somewhere and they don't have any stocks, once they can say they have more purchasing power than someone who's been reinvesting his dividends and his excess income into the S&P 500 for the past 15 years, once gold and silver holders say, you know what, we have all the purchasing power. You, the guy who has the S&P 500 or the Nasdaq or whatever, you've lost it all, and that'll be the end. So if that's what I expect to happen, so is there still time to own gold and silver and to participate in the rally? It's not really a rally; it's just a sucking of purchasing power away from mainstream stocks into money because of the death of credit. Yeah, there's time. Not much, but there's time. The reason for holding silver is very similar to the reason for holding gold, but it's slightly different. I'm pulling up a chart here that I can use to supplement what I'm saying. Hold on. So the reason to own silver is to get through the end of the currency system. That there's going to be a time when credit doesn't work, when you can't buy anything with dollars, and you're going to have some of a liquid commodity to use in order to get through it. Because otherwise, you'll have to, let's say, if you only have furniture and real estate, then you'll have to, I don't know, sell your house for, I don't know, 3, 4 weeks worth of food. That's not a good deal. Instead, you'll want something more liquid that you can buy a month's worth of food and you still have a house. That would be better. You'd survive, but you wouldn't have a house. I don't really look at industrial demand other than for silver. Actually, before we get to that, you asked the difference between owning silver and gold. The point of owning gold is to stabilize your purchasing power, but you're not going to be able to go around when the dollar doesn't work. And when the dollar doesn't work, no currency is going to work because all currencies are based in the dollar. This is just a mathematical fact, because in the basements of all of the central banks, all the foreign central banks that issue other currencies, they are backed by US dollars. The foreign central bank, for example, of Israel, where I live, is the central bank owns dollars, and with those dollars it prints shekels, and they try to balance that exchange rate between the dollar and the shekel. So they try to follow the Fed's monetary policy, print within certain ranges so that the exchange rate doesn't get too fakakta, messed up. And same with other countries. The Ukrainian, is it the hryvnia in Ukraine or something?
Yeah.
They do the same thing. So all other foreign central banks have dollars, and they try to keep their currencies within certain exchange rates, and the only reason they don't is because they're experiencing their own crack up booms, and they can't resist printing too much, because otherwise their own banking systems will collapse. So they just go with hyperinflation instead. And so when that happens to the dollar, all the other currencies collapse with it. The point of gold is to stabilize purchasing power. And you're not going to be able to go around with gold ounce or even a half an ounce and buy retail amounts of stuff. You want silver for that. And that's where the purchasing power is going to be. So if you want to stabilize your purchasing power, you want gold just to sleep well at night, and you also want enough silver to actually get through the worst of the chaos, so that you have liquidity to spend on retail amounts of stuff, so you don't have to sell a luxury car for yes, there is industrial demand for silver, and back when it was the money directly, and that people used it as money, like but prior to 1873, when the dollar was taken off the silver standard, there was basically almost no industrial demand for silver at all. So in today's environment, we're talking about there is an industrial demand for silver, and but there is no direct monetary demand for it right now. But when the monetary demand does reintroduce itself, there's still going to be that industrial demand that is on the side. So it's going to take some of the current silver supply and direct it into industry, so there will be less ounces, fewer ounces to use as money directly when that is required, which will only increase its purchasing power. I don't know by how much, because I'm not an expert in how much it requires silver, and if we're in a monetary collapse, how much of that industry is even going to be functional. I suspect not much of it in the immediate aftermath of the collapse, but as a credit system is rebuilt, I would expect that a lot of that silver is going to go back into industrial demand, and less of it will be available for monetary demand, which will help steady, I think, the purchasing power of silver. We saw in previous collapses, let's say 1980, when silver hit $50, almost immediately went back down. This time, I think it will hit a peak, and then it will gradually fall back down to some equilibrium level that will be less than the peak. But because of the industrial demand that will be reintroduced as the monetary system picks up again and we reintroduce an honest credit system, I think the fall of silver, which I do think will happen after a peak, will be a lot less pronounced than it was in 1980 or 1919 or those other years.
Mike Maloney, a longtime commentator on monetary history and precious metals, has drawn attention to a revealing chart first published in mid-2022 that underscores how much liquid capital is waiting to move into gold and silver. At that time, the figure stood at nearly $16 trillion, far higher than the $7 trillion some later reports suggested, pointing to the vast pool of immediate access money, including currency, demand deposits, and unused credit lines. In just 3 years, this bucket swelled by around $4 trillion, with the most liquid slice, money markets and short-term funds, rising by about $2.5 trillion. To Maloney, the takeaway is clear. There is more money on deck than ever before, ready to flow into safe haven assets at the first sign of instability. He stresses that this phenomenon is not limited to the United States. Similar dynamics are unfolding globally, where liquidity, credit lines, and currency reserves have ballooned into the tens of trillions. This makes the potential capital shift into precious metals far larger than many market participants realize. Maloney cautions that such moves typically happen in bursts, triggered by financial shocks or geopolitical events, and today's fragile backdrop provides ample spark. In his assessment, the world is approaching a tipping point where gold and silver will not just rise steadily, but may surge as pent-up liquidity floods into them, igniting a rally that could redefine the market. Let's get back to the interview.
For everybody out there, I have not seen this chart, and I do not know what the number is. This is a surprise.
Okay, so right now, the old total was just about 16 trillion. The new total, just over 20.
Whoa, look at that growth. And wow, the growth in the money market area, the yellow, is absolutely insane. Currency plus demand deposits and unused credit card lines. So this is, these are dollars that can, within a day, come chasing the safe haven asset in a crisis, and a crisis is coming. October is always the spooky month. We're in September, the end of September right now. October is just famous for crashes. And I really think that we could get a crash as early as this October.
It's definitely possible.
In that case, a bunch of this is going to come chasing gold and silver. If you take a look at this, on the same day, the price of silver was $42.20 in the West, but in China, it was $43.70. 3.56% higher, and that arbitrage causes silver to start moving from west to east. It's not a good thing for the West to have that arbitrage, but that's where the silver is going. And a lot of it's the East that is driving the prices on gold and silver right now. SRS Rocco report. The silver price has never, now this is old. This is from the beginning of the month, September 3rd. The silver price has never closed above 40 on a quarterly chart. $40 is an important level not hit on a quarterly basis since 1980. A close above 40 by the end of September and quarter could suggest even higher prices. So let's take a look and explore this a little bit. Here, I'm on stock charts here. And so this is a daily, and it's a line chart. And here's the thing about line charts is line charts on stock charts is basically connecting the dots of the close price. It doesn't have the intraday information in there. It's just the close. So if we select daily here, that's what it looks like. But then we go to weekly. Still looks very similar. 44.05 is what stock charts says that silver closed at. But you can see this cup and handle, even on a weekly, is almost done. It's almost completed. But now let's go to a monthly. And what we see is that it's almost very close. The cup got tilted a little bit. So the intra-month price action is not there. Now, if we scroll down, we go to quarterly, and bam, we have had a major breakout on quarterly. Let's take a look at yearly, because this had already broken out before. And there's yearly. We have major breakouts on the yearly and the quarterly, saying that this cup and handle is going to be accelerating. This cup and handle suggests 3-digit silver. So it is not too late. We're probably headed up into mid 3 digits. And if we go back to the daily, this bottom down here was, I think it was $3.50. So the difference between $3.50 and these $48 highs, you've got to at least flip this upside down, and that is the minimum. But this is on an exponential chart. If you flip it upside down, it wouldn't just be adding that $47 or whatever this is. It would be far, far, far beyond that on a logarithmic chart. That's probably where it's heading. So from VBL's Ghost, the only silver chart that matters is the annual close. The lid is off, kids. And this is a great chart because it goes all the way back into 1802. And you can see the super spike in 1980. And we are going to be headed for a bubble far greater than the 1980 bubble. The economy wasn't in such dire straits back in 1980 as it is today. Everything is far, far more out of balance than it was back then. Coinstacker says, cup about to runneth over. And I was one of the very first people, I think the first one, to identify this giant, everybody was focused on this cup and handle right here back in 2023 because it was suggesting a big move coming. And the big move, I kept on calling it a slingshot move. These green candles here, that's the slingshot. But then I accidentally looked at a 50-year chart and I went, oh my God, look at that. And so we are headed for some big, big all-time highs. And just one thing to wrap up here, silver has been marching forward and creating a 14-year high after a 14-year high after a 14-year high. And here we closed above $44. Quite amazing. From just 2 years ago, it was down in the 20s. So we've doubled in 2 years pretty much.
The swelling tide of global liquidity sets the stage for a dramatic repricing of gold and silver. With vast sums of capital sitting idle in highly liquid instruments, even a small redirection of this money into tangible assets could trigger a powerful surge. Precious metals have always acted as a magnet when trust in financial systems weakens, and the current environment, marked by mounting debt, currency instability, and geopolitical strains, creates the perfect conditions for such a shift. The effect would not simply be a price rally, but a structural revaluation that repositions gold and silver as core safe havens in an era of deep uncertainty. Looking forward, the future trajectory for these metals appears asymmetrical, with limited downside and outsized upside. Should confidence in traditional markets falter, capital inflows could arrive in waves, driving silver to levels that challenge historical benchmarks and propelling gold into territory that redefines its role in global finance. This would not unfold as a gradual climb, but more as a sudden repricing event once liquidity begins to migrate en masse. The sheer scale of money poised to move suggests that the impact will be both rapid and far-reaching, reshaping how investors, institutions, and nations view hard assets in the years ahead. Share your thoughts on experts' analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.